The IRS doesn't care about the letters on your formation document. The IRS cares about what the records show. Most people think forming an LLC is a tax strategy. It's not. Most people think picking an entity type is something you do once and forget about it. It's not that either. Entity structure is the foundation your entire business sits on. Get it wrong, and everything you build on top of it is unstable. I spent 4.5 years at the IRS examining small businesses. I sat across from owners, reviewed their books, and documented what I found. And one thing came up over and over again. The owner had an LLC certificate. Sometimes it was framed on the wall. Sometimes it was in a drawer they had to dig through to find. Either way, they'd hand it to me like it was a shield. Then I'd open the bank statements. Groceries mixed with office rent. Personal car insurance paid out of the business account. Kids' school supplies sitting next to vendor payments. And that LLC, the IRS doesn't care about the letters on your formation document. The IRS cares about what the records actually show. Most people think forming an LLC is a tax strategy. It's not. Most people think picking an entity type is something you do once and forget about. It's not that either. Entity structure is the foundation your entire business sits on. Get it wrong, and everything you build on top of it is unstable. Get it right, and the legal protection works, the tax treatment makes sense, and the compliance stays manageable. This episode is about understanding what entity structure actually does and what it means when you're just starting out. Because most of you listening right now are already in the system, whether you realize it or not. Welcome to the Zero Fluff Books podcast. I'm Lauren Twitchell, enrolled agent, founder of Zero Fluff Books, and former IRS revenue agent. If you're watching the video version, you already know I'm not showing up in a suit. I'm building a firm, same as you're building a business. But while I might dress like an entrepreneur, I speak the language of the IRS. I've been on the other side of the examination table. I know what examiners are trained to look for, and I know what kind of records make their job easy, and what kind make yours harder. Right now, social media is full of entity advice that sounds great in a 30-second clip and falls apart the second you try to apply it. Just start an LLC and write everything off. Switch to an S Corp and save 15%. None of that means anything without context, and context is what this season is about. Over the next 11 episodes, we're going to walk through every major entity type: sole proprietor, single member LLC, S Corp, C Corp, partnership. And I'm going to explain each one the way I'd explain it to a client sitting across from me. No jargon for the sake of jargon, no scare tactics, just how it works, what it costs you in time and money, and how to know when it's the right fit. But before we get into any specific structure, we need to talk about why this decision matters in the first place, and where most people are starting from without even knowing it. Let's start with the basic question. What is a business entity? In plain terms, a business entity is a legal structure that separates your business activity from your personal life. It tells the state who owns the business, and it tells the IRS how to tax the income that business generates. Here's where it gets confusing for most people, and I want to clear this up right now because it's the single biggest misconception I see. Your legal structure and your tax treatment are two different things. They work together, but they're not the same thing. And mixing them up is how people end up paying for complexity they don't need or missing protection they actually do. Think of it this way. When I was examining returns at the IRS, I'd pull a case and the first thing I see is the tax form. A Schedule C, an 1120S, a 1065, and that tells me how the income is being reported. That's the tax side. Then I'd look at the formation documents, the operating agreement, the ownership structure. That's the legal side. Same business, two completely different layers. Your legal structure is what protects you if the business gets sued. It's the barrier between the business's liabilities and your personal assets. That's where terms like LLC and corporation live. Your tax structure determines how the IRS treats the income. Does it flow through to your personal return? Is it taxed at the corporate level first? Do you owe self-employment tax on all of it or just part of it? That's where terms like sole proprietor, S Corp, and C Corp live. An LLC is a legal designation. It's formed at the state level. By default, if you're a single member LLC, the IRS treats you as a disregarded entity. That's the actual term. They disregard the LLC for income tax purposes. You still file the same Schedule C you would have filed without it. Your tax bill doesn't change. Your legal protection does, assuming you actually maintain it, which we'll get into later this season. So when someone tells you that forming an LLC will save you on taxes, that's not accurate. An LLC by itself doesn't change your federal tax treatment. What might change your tax treatment is making an election, like an S Corp election. which is a completely separate decision with its own requirements, its own cost, and its own compliance obligations. Now that we've separated legal from tax, let's talk about how you actually evaluate which entity structure fits your business. There are three things that matter. I call them the three pillars: liability, tax treatment, and compliance burden. Every entity decision you make should be filtered through these three things. Not what your friend did, not what a TikTok told you. These three. Pillar 1, liability protection. This is about risk. If your business gets sued or if the business owes money it can't pay, liability protection determines whether those problems stay with the business or follow you home. If you're a sole proprietor, there is no separation. You and the business are the same legal person. If the business owes a debt, you owe the debt. Personally, your car, your house, your personal bank account, all of it is exposed. If you have an LLC or a corporation, there's a legal wall between the business and you. But, and this is critical, that wall only holds if you maintain it. If you commingle funds, if you don't have an operating agreement, if you treat the business bank account like a personal checking account, a court can look right through that LLC and hold you personally liable anyway. That's called piercing the corporate veil. It's not theoretical, it happens. Your liability exposure depends on what your business does. If you're a consultant giving advice, your risk profile is different from someone manufacturing a product that people use in their homes. The entity you choose should reflect that. Pillar 2, tax treatment. This is how the income flows from the business to your personal tax return and what taxes you owe on it along the way. As a sole proprietor, every dollar of net profit hits your 1040 and you pay income tax plus self-employment tax on all of it. That self-employment tax covers Social Security and Medicare. It's the equivalent of both the employer and the employee side because when you're self-employed, you're both. An S corporation changes that math. With an S corp, you pay yourself a reasonable salary, payroll taxes apply to that salary, and the remaining profit passes through to you as a distribution, which is not subject to self-employment tax. That's where potential savings come from. But it also means you're running payroll, filing a separate corporate return, and meeting the IRS's standards for what reasonable means. A C corp is taxed at the entity level. The corporation pays tax on its income. If it then distributes profits to you as dividends, you pay tax on those dividends personally. That's the double taxation concept you've probably heard about. It's not always a bad thing. It depends on the strategy, but you need to understand it before you choose it. The point is, every entity type has a different tax treatment, and that treatment has real dollar consequences. We'll break down the math for each one as we go through the season. Pillar 3, compliance burden. This is the one that nobody talks about on social media, and it's the one that trips people up the most. Compliance burden is the time, the cost, and the administrative weight of keeping your entity valid and your filing current. Every step up in entity complexity adds compliance requirements, and if you don't meet those requirements, you lose the benefits you choose the entity for in the first place. Sole proprietor, minimal compliance. You report your income on Schedule C. You keep your records, that's the baseline. Single member LLC, you add an operating agreement, a separate bank account, and a state level requirement like annual reports. Those vary by state, so check with your state directly. S Corp, now you're running payroll. You're filing a separate corporate return, the 1120S. You're issuing K1s. You're maintaining corporate minutes. You're tracking shareholder basis. The list gets longer. I've seen business owners elect S Corp status because someone told them it would save money. And then they didn't run payroll. They didn't file the 1120S on time. They didn't pay themselves a reasonable salary. And now, instead of saving money, they've created an IRS compliance problem that costs more to fix than the taxes they were trying to avoid. The takeaway here is simple. Don't choose an entity you can't maintain. The structure only works if you follow through on the requirements that come along with it. Now let me bring this home to where most of you are right now. Because there's already a good chance you're already a business owner in the eyes of the IRS, you just might not know it yet. Here's something most people don't think about. You listed something on Etsy last night, or you said yes to the neighbor who's been asking you to mow their lawn for $50. You wake up, you see that first sale notification, and it feels like a win. In that moment, without signing anything, without visiting a government website, without filing a single form, you became a business owner. The IRS now considers you a sole proprietor. No paperwork required, no state filing, just you, your income, and a form called Schedule C. The IRS doesn't have a side hustle category. If you're doing something with the intent to make a profit, you have a business. And if you haven't formed an LLC or a corporation, you're operating as a sole proprietor by default. That's not a problem, it's just a fact. And understanding what that means for your taxes and your liability is the first step. In a sole proprietorship, your business income and your personal income are the same thing on your tax return. There's no separate corporate return. Everything goes on Schedule C, attached to your Form 1040. Whatever the business earns, you earn. Whatever the business owes in tax, you owe. The biggest challenge at this stage is the identity problem. Because you and the business are legally the same person, it's easy to run everything through one bank account. Business income and personal expenses mixed together, that's called commingling. And even though you're not legally required to have a separate entity, your records still need to be separate. Commingling is the number one reason sole proprietor audits turn into expensive problems. Being a sole proprietor is a legitimate starting point. There's nothing wrong with being here. But you need to run it with the same discipline you'd bring to any other business structure. Here's where we're going this season. Next episode, we go deep on Schedule C, the form that defines your tax life as a sole proprietor. What goes on it, what stays off of it, and the self-employment tax calculation that catches every new business owner off guard. From there, we'll cover when to move beyond the sole proprietorship and what a single member LLC actually does and doesn't do for your taxes. Then LLC compliance, the ongoing requirements that keep the entity valid. Then we take a detour into social media tax myths because you need to be able to separate the real provisions from the viral fiction before we move into more complex structures. After that, the S Corp, 3 episodes covering the election, reasonable compensation, and operational reality. Then the C Corp and partnerships. And we'll close with a decision framework that ties everything together based on your business stage. Every episode is designed to stand on its own. If you're already past the sole proprietorship stage, you can jump to the episode that's relevant to you. But if you're building from the ground up, start here and work through the season in order. I'm Lauren Twitchell. Keep the fluff out of your books, and I'll see you next week.